This is Daniela Camboni for Kitco News, and joining me on the spot today is one of North America's most successful entrepreneurs. He's Kevin O'Leary, chairman of O'Leary Funds, a $1.5 billion mutual fund company. He's the star of CBC's Dragon's Den and ABC's Shark Tank, and the author of Cold Hard Truth. Kevin, what am I missing from this resume?
I'm just having fun trying to scratch out a living, that's what I say.
Just a tad busy these days.
Yeah, definitely.
So Kevin, for our viewers out there who are new to O'Leary Funds, tell us a little bit about your background and what your company is about.
You know, the genesis of the company was to manage my own wealth. I was lucky enough to have a liquidity event a while ago when I sold the learning company to Mattel. It was a large transaction. There was about 14 of us as founders. We sold it for $4.2 billion, so it was a huge liquidity event for us. And I began to look for managers to manage my money. And I remembered a story, and it really affected me years ago. My mother, I was born in Montreal, worked at a company called Kitty's Togs. And she used to come home and tell my brother and I, because they pay them every week on Thursday mornings, she'd always invest a third of her paycheck into Bell bonds with coupons. She'd always say to me, boys, never spend the principal, just the interest. And never, ever, ever, ever buy a security that doesn't pay a dividend.
Right.
And you know, back in those days, stocks paid higher dividends than the bonds. So example, you know, Bell Canada had a 6% yield on its 5-year paper, its bonds. The stock yielded 7 to entice people to take the risk to own an equity. And we got lost somewhere between the 50s and the 60s and 70s. And we actually thought that it was a good investment to buy a stock that didn't pay a dividend, which to me is insane. So anyways, I wanted to found a firm on that, my mother's basic concept, because you know, she died a few years ago and I was executive for her estate, and I looked at her portfolio, which she never shared with anybody, but 40 years compounded dividends and bonds. You know, 73% of the market's returns over the last 40 years came from dividends, not capital appreciation. And she knew that intuitively. So that's how we built the foundation of O'Leary Funds. We listen to Mom. We don't own a single security that doesn't pay a dividend. I will never buy a stock in my life that doesn't pay a dividend. If it's not returning cash to me, it's a speculation. And if a manager can't send me cash, I'm not interested.
Right. Well, you mentioned that often in your book, Kevin. And what's the typical investor like of O'Leary Funds?
You know, they're probably in their 50s, 60s, 70s, and even older. Their number one mandate to their own investment strategy is preservation of wealth. Secondly, it's income. And lastly, on the hit parade, is capital appreciation. Right. The only way we get capital appreciation is we find companies that are growing free cash flow. I don't believe in earnings. That's mumbo jumbo to me. I believe in free cash after CapEx. You tell me how much free cash flow you're making every quarter, it's the only thing I care about. I don't want to hear anything else, because if you're not, you can't lie about cash. That's what I love about cash. There's no vision, there's no story, there's just cash. And that's what I trust and that's what I understand. So I find companies that are growing cash. I buy their debt, their prefs, their converts, their common shares because they're paid a dividend, and I wait in the weeds. I get paid every single quarter. Anything that doesn't pay me cash, not interested.
What areas of the world do you like right now where you're investing?
You know, I look at it very simplistically. I say, where's the GDP growth? Because that's the rising tide for any operation. A telco, a toll road, a consumer goods company. You'd rather own that in a country that has GDP growth north of 3%. So right now, you know, I used to be 70% invested in Canada. I'm down to less than 25% here because we're not growing. We're not growing in the US. I like Brazil, India, China, Asia, Cambodia, Thailand. They got it cooking over there. They're growing. So I'd rather own the Brazilian telco than any Canadian telco. I mean, you look at the worst returns in telco are in Canada. You can buy a Brazilian telco that's been a phenomenal investment for the last 5 years. And the great thing about these companies overseas is they're so big now, so huge, they're issuing the securities in US dollars, and I can hedge that back to the Canadian dollar for next to nothing.
So you mentioned China. Are you liking the base metals right now, like copper?
I do, but here's the problem with owning the base metals, in my way of looking at the world. With the exception of gold, which I own a 5% weighting of my net worth in for reasons we'll talk about later, I'd rather own a service provider that mines copper or provides utilities to the copper mine that pays me a dividend. I'd rather own a pipeline than the oil that flows in it, because commodities have this nasty habit of being very volatile and they don't pay you to wait. Where's my cash? Where's my check every month? I don't want to speculate on what copper is going to be worth next week. I'd rather own a company that's providing high-pressure trucks to copper mines that sends me a 5.5% dividend, and I do own that company. I get paid every single quarter. Cash, 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 cash.
Okay.
That makes me feel warm and fuzzy.
Okay. So what do you think about the gold mining stocks right now, and why maybe they're not performing in tandem with the price of gold?
Idiot management. The problem is the management of gold companies can't control their costs. I interview every gold CEO.
Yeah.
They come into the CBC or they come on the Lang-O'Leary Exchange. I ask the same question to all of them. Look, give me one reason I should own your stock and not the gold you mine. Because I show them his chart, I show them the price of gold, and they are ugly. You'd rather own gold. Never own the miner, own the gold.
You think physical gold?
Yeah, well, here's what I do. I own physical gold for 50% of the position, so 2.5% weighting. And I use the GLDs, which are an American
Right.
U.S. pay
Right.
or U.S. Currency, product. And then I, supposedly own the physical gold that way. But what I like about the GLD is I can trim my weighting every month. So when it gets over 5% weighted, I ping off a few GLDs or I buy in the GLDs.
Right.
Physical gold, I go hug at night.
Right.
I think the thesis that many people are bringing to me now is, why not switch out of gold and the GLDs and buy the miners? They've had the living you-know-what pounded out of them.
Yeah.
They're at the lowest valuations vis-a-vis the commodity itself.
Right.
And I say they're going to go lower.
Wow.
I really do, because there is no reason to own if you look at almost everyone except the royalty ones, their costs keep going up in every case. I say they're mismanaged. I say if a manager can't control his costs, fire him, get somebody else who can. Because if your cost of mining the actual ounce keeps going up, why would I ever buy the stock? Give me one reason.
There's no mining CEO you like right now?
Oh, I love them all. I just would never buy their stocks. They're great people.
Right.
But you tell me one reason I should own the common. Give me one reason. Dividends are practically nil across the sector. You have huge operational risks. You've got idiot management on the juniors. Not that they're bad people. I'm just saying the cold, hard truth about investing. If you want exposure to gold, buy the gold. Forget the miners.
But do you think part of the problem is there's too many juniors on the scene, for example?
Oh, it's just a wasteland. It's carnage out there. We had the PDAC conference here. They were rolling in like ants into the CBC to get interviewed. I talked to all of them until the story got to be the same. Like it's the same story. Oh, woe is me. I can't raise any dough. My costs have gone too high. The mine is delayed 6 months. We're not in operation. After a while, it's just the same drone. It's boring. And I'm thinking to myself, these poor guys, their life must be hell. The definition of you're a bad person on earth is you go to hell and you run a gold mine.
Okay, Kevin, tell me, why do you like gold?
I like gold because, in a way, it's a stabilizer. It's an insurance policy. I listen to all the gold pundits, and they're always wrong as far as I'm concerned. It's impossible to time the moves. I've owned gold for decades, and I simply have a 5% weighting. I look at it quarterly. When it becomes more than 5%, I sell into the strength. And when it weakens, I buy into the weakness. It's just a stabilizer. I'm not one of those guys that's going to go to 40% weighting in gold.
Okay.
I don't believe the hyperinflation story. It hasn't happened. Gold is popular for a whole host of reasons. And 5% seems to be enough. It's worked for me in portfolio management. It's the only security I own that doesn't pay a dividend.
So, Kevin, I guess, do you not care if gold goes to $2,000 or $5,000 an ounce? You're still going to buy gold?
Yeah, I don't care. Like, let it run. I'll be selling into that strength, keeping it a 5% weighting. What I've learned, I'm an old crusty investor. When everybody's saying you got to own it, you should be selling it, because when it corrects, it doesn't touch the sides on the way down. So I simply say 5% is good for me. Some people like a 10, 15% weighting. I'm a 5% guy, and I'm disciplined about it. I hope it runs to 5,000. I don't care. I'll be selling all the way up, keeping it at 5%. And when it corrects back down to 2,000, I'll be buying it in. It's fun. That's the way you should work with gold. Never get so caught up that you take all your dividend-yielding securities that are also a hedge against inflation and put it into a commodity like gold.
What do you think of people who say we should go back to a gold standard?
That's unnecessary. We're in a global economy now. You think about what's happened with currencies. Here's my strategy with that. I simply say, look, if I'm domiciled in the country where I pay taxes, which for me right now is Canada, I have 50% of my cash in Canadian dollars. Then I diversified through every other currency. I own US dollars, I've got a 20% weighting there. I own Swiss francs, I own euros. I don't need the Aussie dollar because it's too correlated to the Canadian. And I sit and wait. people are trying to tell me, let's FX here, let's FX there. Nobody can make money in FX trading. You blow up when you try and do that. So just own a basket of currencies, and then, you don't know who's going to raise rates first and what the deltas are going to be, but you're protected that way.
Speaking of currencies, do you think we'll see a shift in a global reserve currency one day?
I think in my lifetime, which I hope is a lot of years left, we will see the Chinese yuan take over. I just look at my investments in that country. They're volatile, but the performance and the growth metrics are fantastic. I can sense the cash moving out of North America. Old and fat and slow growth. We're the Romans now. And then I look at where I'm making all my money. It's all happening in Brazil, India, China. So scale. The Chinese economy is going to overtake North America during my lifetime.
A lot of people are alluding to this now, Kevin. So.
Yeah, but look, there's nothing, look, when you have tax policy and confusion, and I think, the American economy was burdened by being the policeman of the world. They've just figured out that doesn't work, but they're trillions of dollars in debt. I don't think you're going to see the Americans jump into the next war anytime soon. It's just too expensive. That whole experience in the last 7 years has been horrible. We as Canadians should also look at that example and say, let's take care of our own cooking here. Let's make sure that we pay down our debt. The most mismanaged province in Canada right now is Ontario. And the government here has stalled the declines in the provincial taxes. They've raised a super tax on the rich, which never works, by the way, never. They're going to have less tax revenue than they started. They're so dumb that way. That's a huge mistake. You think the rich are stupid? They're just going to defer their income or take it right out of the province. They'll leave. It's a very bad strategy. The British tried it, and they lost revenues. They raised it to 50%, now they're dropping it down again.
So let's look at the U.S. a second. Do you think that we'll see more money printing there? Will we see a QE3 perhaps?
I think in a way QE3 will happen because I look at some just fundamental issues that what we needed to see was 400,000 jobs a month. We're nowhere near there, or at least 33% less than that. That's just a break even to stop unemployment. But it's the housing that has me nervous. It refuses to come back. And you just looked at last week's Price-Shiller numbers, and they're down, even in cities like Boston. Miami's recovering a little bit, but the major centers are still anemic. And that's a problem because until Americans feel that their core asset, their home, has stabilized, they're not going to have the animal spirits, and they're going to continue to have less buying power. So it's a problem. I'm not calling for collapse of the U.S. markets. In fact, they're doing very well because the S&P has 52% of its sales outside of North America. But the core underlying growth of America is going to be sub 3% for a couple of years and maybe longer.
All right, Kevin, let's just get back to your book a second.
Sure.
In it, you say you really know whether you're born to be an entrepreneur or an employee, right? So how did you know?
I tried working for somebody when I was very young, and they fired me.
Right, in ice cream.
Right, and it was a very, very profoundly, affected me profoundly, and I just said, I'm never working for anybody again. It doesn't mean your life is easier. In fact, you have to have a lot of sacrifices on the road to success and a lot of failures along the way. I just find it a more interesting way to spend your time, and I really believe in this concept of money buys freedom.
Right.
And so, I think it's a very noble pursuit for some percentage of the people out there, but not for everybody. Because you have to sacrifice a lot for the period that you're working on your business. And not everybody wants to do that. And I think you find that in your own. You start down that path, and if it's too much of a sacrifice, you revert back to being an employee. It's very noble to do that too, but it's not the same thing. It takes a long time to set yourself free working for somebody else.
And in your book, you also say when you're investing, you should have an element of fear in there.
You should make the assumption when you make an investment, there's some probability you'll lose it. It'll go to zero. And that's why you need to have, a reserve, like a backup plan, some cash set aside that if everything blows up, you're okay. I find it extraordinary when people make their first, liquidity event and they have some capital, that they blow it all again. That is the biggest mistake. You've got to take a nut, even if it stays in cash or it's a very, very liquid, safe securities, and say, that I don't touch. It goes back to what my mother taught me. Spend the interest, never the principal. I mean, look, I make a lot of crazy investments. I don't touch the principal.
What investments are you liking today?
I'm liking very simple deals where I can understand the business model. I'll give you an example of how boring and simple and how successful it can be. This is from Shark Tank. You know, I look at a lot of deals on Shark Tank and on Dragon's Den because I invest 5% of my net worth every year in venture deals. So I used to have to go find them. Now they come to me. I've got 2 platforms to work on. This is a Shark Tank deal. So Oprah has a hairdresser. Interesting guy. He's his hobby was tea. This tea you drink. And he became what's called a nose. He had a certain skill to be able to smell Ceylon teas, and blend them. One day he gives, a couple of years ago, a cup of tea to Oprah while he's doing her hair, and she sips it and says, "It's the best tea I've ever had." She goes on the show half an hour later and says, "This tea, called Talbot Teas, is the best tea I've ever had." He gets orders the next day for $500,000. You know the Oprah effect, you've heard of it, right? He can't finance that. So he comes on Shark Tank and he's looking for $250,000, and I agree to buy 35% of the company for that. I love tea, it's so simple. Gets on Oprah, 500,000 orders, Neiman Marcus, all kinds of individuals ordering on the internet. Simple. Tea, orders, cash flow, right? While we're in the middle of doing the deal, the show airs, and Jamba Juice, a public company, says, "We want to be in the tea business. We love this story. We love the brand. I want to buy the company." I haven't even written the check yet. And bang, the deal's done.
Wow.
Yes, wow.
Yeah.
That's the kind of deal I like because it was simple. It's not a complicated tech story. It's tea. Tea with a brand. Now you go into a Jamba Juice anywhere in North America, that's my Talbot Teas. That's right. Isn't that wonderful?
It is wonderful. That's why you are.
Well, that's why I am Mr. Wonderful. But you know, I look at it this way. The simple deals are the ones you make money on.
Okay.
So I take that cash back, I redeploy it. So I like simple stories with revenue attached to them. You know, the high-tech stuff, I came out of that market. It's so complicated, so much can go wrong. So I just love deals where they see an easy path to revenue.
All right, Kevin, finally, if you have some final thoughts for investors watching out there.
Diversification is the only free lunch in investing, and I see this happen so many times. Here's my basic lesson that I've learned that I never vary from, and this works. Trust me, it works. Never more than 5% of your portfolio in any one name, no matter how great the story is. If it's the next Nortel, if it's the next RIM, who cares? 5% max weighting. For me, usually it's 2.5 to 3%. I never let a stock get bigger than that in my portfolio. I sell into the strength all the time. Secondly, never, ever, ever more than 20% in any one sector. So if you love gold, you just can't get past 20% of your net worth in gold, or energy, or any other sector, or financial services. So good sectoral diversification is crucial. And finally, for me, I'm over 60% weighted in debt now versus equity. Not government debt, not treasury bonds, but corporate debt. Remember that a BB or BBB bond is serviced before they pay the dividend on a common stock. So I like to own right up the balance sheet. So I own a lot of prefs, converts, senior debt, floating rate notes. I love that stuff because when they get upgraded, I get capital appreciation. Meanwhile, I get a check. The key to life is the check coming in. It's the cash. If you always, always, always look at the free cash flow, this will keep you safe because the only friend you're going to have when you're old and crusty is not your dog, not your kids. It's the cash in the bank that's still going to love you.
Kevin, thank you so much.
No problem.
And thank you for watching this edition of On the Spot. You can email me, as always, at newsfeedback@kitco.com.